Hi everyone, welcome to Audit and Assurance crash course for ACCA December 23 exams. This crash course will be helpful for people who are going to resit for the exam and you need a last minute recap and last minute preparation videos. So this will be a recap of all the contents that are very necessary to remember as a last minute points for your exam. Okay, so this one I'm going to split into three parts. The first part will be syllabus recap. So I'll be discussing all the important topics right from the start for the complete audit process, right from the start till the review and reporting. This will be part one. Part two will be mock debrief videos. Your exam pattern is normally section A and section B. Section A is where you will have three case-based questions for which MCQs will be there. For each and every case-based question, you will have 5 MCQs, 2 marks each. So total of 30 marks. That is section A. Section B will be long answer type questions. First question will be 30 marks and two 20 marks questions will be there. So this is your exam pattern for AA. Now, my part 2 will be the mock debrief for 30 marks question as well as the 220 marks question. So I'll be elaborately telling you how to answer the question, how to read the question, what is the examiner's expectations for the answers, and what are the common mistakes that students make. Okay, so this is going to be part 2. Part 3 will be helping to crack the MCQs. AA paper is not something equal to PM, FR, or FM. So there you have more practical problems. You have calculations. So once you're clear with the concepts and you can get the calculations properly, your answer will be correct. But AA is a place where students find it difficult because theoretically, when you look at the options, it seems to be similar. Like option A may be similar to option C, so they get confused. So I'll be helping you with how to crack the MCQs in part 3. Okay. Now starting with my part 1. Okay. This is going to be the syllabus recap, first of all. So starting with audit and assurance, basically. Let me share the screen. Okay. So now what is basically audit and assurance? Audit is one form of assurance. Okay. So assurance has two things to remember. One is audit engagement, and the second one is review engagement. See, review engagement is basically you're not going to perform an audit, it's just going to be the review of the financial statements of the client. But audit is where, for example, I am the audit firm and you are the client firm for me. So basically, I'm going to audit your company's financial statement. Now, audit engagement is where I will be carrying out an independent examination of the financial statements of the company for which I am appointed as an auditor. So basically, here I'm going to audit your company's financial statements. That is, I'm going to independently examine your financial statements and provide an opinion on the financial statements. So, this opinion is normally about the truth and fairness of the financial statement. That is, whether the financial statements are free from any material misstatements and it is free from any errors. Okay, so this is what I'm going to perform as a part of audit engagement. Now, what kind of assurance can I provide based on these audit engagement and review engagements that I'm going to carry out? Will I be able to provide an absolute assurance? That is, will I be able to give a guarantee that yes, these financial statements that I have audited are completely out of material misstatements? Can I do that? The answer is no. I'll not be able to provide a complete guarantee. No, I cannot. Because, for example, I'll be going in detail with this with other topics, but for your simple understanding, when we are going to audit, it I have thousands of transactions. Okay. Out of this thousands of transaction, will I be able to audit all these thousands of transactions? Auditing is I'm going to check whether any errors are there, okay, omissions are there, any problem is there with this. any misstatement. So will I be able to check all these 1,000 transactions? Obviously, no. So I'll be selecting a sample out of it, a few samples. For example, I'm going to select a 40 samples out of it. Out of the 1,000, I'm just going to check 40 samples. So I cannot guarantee out of this 40 samples, I'm telling yes, there are no errors, there are no omissions, it is free from material misstatement. So I cannot guarantee other 960 of the transactions will have no material misstatements at all. So therefore, this audit engagement is not going to provide me a guarantee. I'm not going to give you a guarantee that the financial statements are totally free from material misstatements. I'm just going to provide an assurance, that is, if I do an audit engagement, then I'll be providing a reasonable assurance. Reasonable assurance is normally in a positive form. That is, from the procedures that I have performed, I conclude that the financial statements are not materially misstated. Okay, so they are true and fair. This is the positive way of conveying. Thus, this is called reasonable assurance. Review engagement is where I have not carried out a complete audit procedure as well, just a review of the financial statements. So now I'm not going to guarantee again. This is not going to be a guarantee. And as I have not completely done an audit procedure, I can just give a limited assurance on this. Limited assurance will be in a negative form. This is nothing but I'll be conveying that they are not materially misstated, but in a negative way. For example, it will be like from the procedures performed, I have not come to any instances or there have been no points that jumped out telling me that there could be some kind of material misstatements. Okay, so this is the way in which limited assurance will be conveyed. So the same thing, but in a negative way. This is called the limited assurance. So the level of assurance will be either a reasonable assurance or a limited assurance. Okay. Now, for this assurance engagement to exist, please bear with my handwriting. Okay. So for this assurance engagement to exist, what are the elements you think are necessary? Okay. So to come into play, like assurance engagement has to exist. So what are the things that are necessary? First of all, there are 5 elements. Okay. The first element is the three-party relationship. Three-party relationship, that is, I already told, I'm the audit firm, you are the client firm, and then the third party will be the intended user. So basically, the first one is the practitioner. There should be an audit firm who has to audit the financial statements. So I'm going to audit the financial statements of whom? I'm going to audit for the client company. So they are called the responsible party. Why are they called the responsible party? So, for example, you are my client firm, I'm the audit firm. So, why am I calling you as a responsible party? It's because I'm going to get all the information. You are responsible for providing me all the information, the documents, and whatever documents I need for the audit. So, you are responsible for providing me all the information related to the audit. So, you're called the responsible party. Then, the third party will be the intended user. They are nothing but the stakeholders. For example, shareholders who will be interested in knowing the running position of the company. They'll be interested in knowing the truth and fairness of the financial statements. So they are the intended users. So basically, you need a three-party relationship. That is practitioner, responsible party, and the intended user. Now, the second element is the subject matter. I know that I have started my audit. I am going to audit. There is a relationship. We have three parties to this engagement. Now, what am I going to do actually? What am I going to audit? That is the subject matter. This is nothing but the financial statements. This is what I'm going to audit. Now, I'm going to audit the financial statements, but um, against which this financial statements will be evaluated. So that is called the criteria. This is the third element. So against which I'm going to evaluate this financial statements. For example, it could be IFRS or IAS. When ACCA is concerned, we are studying IFRS and IAS, right? So the financial statements, whether the financial statements that I'm going to audit, based on which criteria I'm going to evaluate it, whether the financial statements have been prepared in accordance with the IFRS or the IAS. That's what is my criteria. Okay. Then the fifth one, so I have audited, right? Now, before my conclusion, before I reach a conclusion, and to support my opinion and conclusion, I need some evidence to support my opinion. So, this is my fourth element. This evidence has to be sufficient and appropriate. We need a sufficient, appropriate evidence. Sufficiency will be related to the quantity of the evidence that you have obtained, and appropriate evidence is nothing but the quality of the evidence that you have obtained. So whether this evidence is enough for me to conclude and provide an opinion on the financial statements engagement that I've carried out, the audit that I have carried out. Okay. Next, these are the four criteria, and the last will be the assurance report. Okay. So this is where I'm going to provide my audit opinion. So once I've carried out my audit engagement, I'm going to provide an opinion on the financial statements based on the audit that I have done and based on the um, evidence that I have obtained. Okay. Now we know what are the elements of the assurance engagement. Now we are starting with our audit process. Where does the audit process actually start? It starts with obtaining the audit engagement, right? Now, first of all, you have to obtain the audit engagement. Obtain and accept. So, obtaining the audit engagement, it can be through, you cannot directly obtain without any kind of process, right? It can be either through a tender or through ads or through some kind of referrals. So you're going to obtain the audit engagement, and before the acceptance of the audit engagement, you have to follow certain things, that you have to look at certain issues. They are client related things has to be looked at, and then you have to look at audit firm related criterias, not criterias, but certain issues that you have to sort out before accepting. And then there are other few. First one, relating to the client related things that you have to look at before accepting the audit engagement is, first of all, the reputation and the integrity of the company, the board of directors in the client firm. Then the level of risk that could be associated with taking up the client firm. So, what are the risks that are associated with? For example, what is the business risk that the company is already facing? Whether that will have an impact if you are going to take up this audit. Okay, so these are the things. First one is the reputation and integrity of the directors. Then the level of risk associated with the company, that is the client firm, and what is the audit fee that I can obtain. Okay, these are the client related criteria that you have to look at before accepting the audit. Then you have the audit firm related criteria. They are, first of all, whether you will be able to comply with the ACCA Code of Ethics. So, the fundamental principles as per the ACCA Code of Ethics, we are studying this right from our F1 till the last 13th paper. Okay, so the fundamental principles are, hope you all remember: integrity, objectivity, professional competence and due care, confidentiality, and professional behavior. So all these, whether we will be able to comply with these code of ethics. If not, what could be the reasons? There are threats, right? There could be possibility of some threats where you will not be able to follow these fundamental principles. What could be the threats? You would have learned, once you have learned this AA, you would have learned all the threats. That is self-interest threat, self-review threat, intimidation threat, advocacy threat, and familiarity threat. Okay. So these five threats could arise. If at all, if these arises, whether, so just because a threat could arise doesn't mean I cannot take up the audit engagement at all. If that's the case, no one will be able to carry out any audit. There could be threats that could arise even once after you have accepted. Also, there are possibilities that these threats could arise during the process of the audit engagement. But you need to know how I can safeguard from this and follow the code of ethics. So you need to plan for the safeguards. Okay. So the safeguards has to be in the place. So this is the first thing that you have to look at. Then you have to consider the competence. Competence to perform the work. Whether you have the appropriate resources, skills, and knowledge. Whether you have the appropriate experienced staff who can perform the audit, and whether you have the appropriate resources, the number of people, number of staff you need. Okay. So all this, whether and you do you have the skills, the staff have the skills and knowledge in order to perform this particular client audit. These have to be looked at. So the competence have to be checked. So these are the things that are considered when related to audit firm. Then the last one could be the um, communication with the outgoing auditor. This is not relevant if you're going to take up a new audit engagement. Like it's going to be a new client firm. They have just started up their business and you're going to audit. They have not audited so far. So then this is not relevant. But if there has this company you're going to take up after a few years of audit where an outgoing auditor has either been removed or resigned. Okay. You need to communicate with the outgoing auditor. First of all, you need to ask the permission from the client company in order to communicate with the outgoing auditor. So, what are you actually going to communicate? You need to obtain a professional etiquette letter from the outgoing auditor. You need to know what was the reason behind their removal or what was the reason for why they were resigning from the audit. Okay, and all the other details. Now, if the client company does not give you the permission in order to communicate with the outgoing auditor, you need to rethink on whether to accept this audit engagement or not. Then, otherwise, the client company has given the permission to communicate with the outgoing auditor, but the outgoing auditor has not responded to you regarding your questions, your queries. Okay. Then again, you have to try to communicate with them. Otherwise, you have to rethink on accepting the audit engagement and think of circumstances why they are not responding. Otherwise, and then the outgoing auditor has communicated with you, has answered to all your queries, then it is up to you to either accept or decline the audit engagement. Okay. So these are the things you will be looking at before acceptance. And now you're clear with all these criteria, you're going to accept the audit. So on acceptance, what am I going to do? First of all, I'll be signing the engagement letter. The audit firm will be signing the engagement letter with the client firm. So, what could be the components of the engagement letter? They will be mentioning all the management responsibilities, the auditor's responsibilities, and the auditor's main thing that has to be mentioned is I should not have any restriction to the access of the documents, reports, whatever information I need for the audit. Okay, then it will also be mentioning the relationship between the internal auditor and the external auditor and the relationship with the management. Okay, and also the audit fee. So these are the contents, and there are few more. Okay, so I'll be signing the engagement letter and then I'll be starting with my audit process. Now, before starting with the audit process, I would like to make sure you know one thing, that is the audit approach. Okay, so audit approach, we will be seeing internal controls and substantive testing, substantive procedures in detail in the next videos, upcoming videos. But now I want you to remember the audit approach. So basically, there are two approaches. It can also be called a left hand approach and a right hand approach. Okay, so the first one is internal controls are higher in the client company where you're going to audit. Internal controls will be relating to the processes that the company has, whether they have proper controls in place that could prevent the fraud or error from occurring. Okay, so whether there are proper internal controls in the company. If the controls in the company you think are reasonably higher, you expect it to be higher, then you can rely on the work of the client firm. And then what you will do, you will plan for lesser substantive testing. Okay, because already the internal controls are more. So the substantive testing can be lesser. You can rely on the work of the client firm. Next approach is where the internal controls are lesser. Now you have performed test of controls and you expect that there are reasons where you expect the controls are not up to the play mark in the client firm, or else though there are internal controls you think they are having more deficiencies, they are not up to the level which can prevent, detect or correct the misstatements and problems. So you cannot rely, okay, you will not be in a position to rely the financial statements, the controls in the client firm. So you're going to perform higher of substantive testing. So when your internal controls are higher, you can rely, you can perform less of substantive testing. But you think the internal controls, there are reasons why you expect the internal controls are lesser in the client firm. You will not be in a position to rely those controls. So you will be performing higher of substantive testing. So this is normally called a left hand approach and this one is called the right hand approach. Okay. So now this is the audit approach you need to remember before going on with the audit process. So the next thing that we are going to look at is starting with the audit process. First thing is audit strategy. You will have to know what is the overall approach to the audit. Only then you can implement it. Okay. So the overall approach to the audit has to be formulated. That is, audit strategy has to be formulated. This is the overall approach to the audit. And then this audit strategy, using this, we will be implementing to formulate an audit plan. Okay. This audit strategy will be including understanding the entity. So first of all, as a part of the overall approach to the audit, we are going to understand the entity. So what does understanding the entity mean? What are we going to understand? How are we going to understand? What and how? Okay. So first of all, what are we going to understand regarding the entity, that is the client firm that I'm going to audit? First of all, I'll be understanding what is the nature of the entity, nature of the business that the client firm is doing, and what are the accounting policies that are being followed, what is the current financial performance of the entity, okay, and um, other things could be what are the controls in place, what is the internal controls in place, and what are their processes. Okay, so these are the things I'll have to understand. How I'm going to understand all these, that is the second question. That can be through different things, different processes. Either I can inquire with the management, or I can do some observation of the processes, inspection of documents, And then I can also perform analytical procedures, so on, and understand the entity and its processes. Okay, I'm going to understand the entity, environment, and all the processes of my client firm. So this is my first step. Second, I have obtained an understanding of the entity. Okay, now I have to find out what are the risky areas of the financial statement. Okay, how am I going to do that? I have to find out the audit risk. Now, what is an audit risk? Okay, what is an audit risk and when are we going to consider the audit risk? Whether we will be eliminating the audit risk to a complete zero or, and then what are the stages in which we are going to consider the audit risk? What are the components of audit risk? Okay, so basically, starting with audit risk is nothing but the risk of providing an inappropriate audit opinion. Okay. So, audit risk is the risk of providing an inappropriate audit opinion. Now, what are the components of this? The first one is inherent risk. Inherent risk is nothing but a risk that already exists in first place. That is, for example, there are no appropriate controls, and there are the risk of misstatements being material, okay, in the company. For example, for your simple understanding, there are some transactions you have purchased. The company has purchased some materials. Now, the payment has to be sent to the supplier. Okay. Now, whether the payment directly goes without any kind of authorization. The inherent risk here is there should be some kind of an authorization before the payment is being released from the company. If there are no authorization, then there is also a inherent risk. Okay. And then you have control risk. Control risk is where the controls that are in place for all the processes is not very proper enough to prevent, detect, or correct the misstatements. Okay, so that is called control risk, which is basically there are deficiencies in the controls. Inherent risk is where there are no proper controls and there is a risk of misstatements being material directly. This is in first place. Second one is there are controls, but which are deficient. They are not proper enough to prevent, control, or detect the misstatements. Okay. Third one is detection risk. Detection risk is that me being as an auditor, I'm not going to detect the material misstatements. Okay. So there are misstatements, material misstatements. What if I don't predict that? I fail to find out the material misstatements. Okay, so that is my responsibility. So basically, this detection risk is the responsibility of the auditor. Inherent risk and control risk is the responsibility of the management. Okay. I am not responsible for the controls that are not in place or the controls that are deficient. Okay. The auditors cannot be held responsible for the inherent risk and control risk, but they can be held responsible for not detecting those risks. Okay. So that is the detection risk. Now, inherent risk and control risk together are called the risk of material misstatements, or it's called ROMM, ROM. Okay. Now, risk of material misstatement can be found at two levels, that is the financial statements level or the assertion level. For your basic understanding, risk of material misstatements, I can give you an example with IAS 38, where you have intangible assets, you have this research and development cost, right? So, what do you do with the research and development cost? Research expenses are normally expensed in P&L, and the development expenditure is capitalized on meeting the few criterias. Okay. Now, what if the criterias have not been met for the expenditure and then you treat it as a development expenditure? You normally tend to capitalize it, though they have not met the criteria. So basically, it is a research expenditure that has to be expensed, but you have capitalized it. So you have overstated your SOFP, right? Now, this is the risk of material misstatement. You're going to overstate or understate or even misstate the amounts or transactions, right? Now, this can be either at the financial statements level or assertion level. Assertions I'll be teaching in detail in the next videos. Now, financial statements level is where this is going to affect a lot of assertions. It's going to affect the financial statement as a whole. Okay. Assertion level, the example could be there should have been some disclosure of particular directors' emoluments or particular items, but the disclosure has not been disclosed properly in the financial statement level. So either at the assertion level means it can affect the accuracy, valuation, or completeness or occurrence. Okay, so that is at the assertion level. Now, coming back to the audit risk. Now, as I said, inherent risk and control risk are the responsibility of the management. Now, what if the inherent risk and the control risk in the client company are higher? Okay, so these two are going to be higher, which means I have a problem that I can go wrong, I can fail in order to find out these misstatements. Now, how can you split this detection risk? That is sampling risk. There are again two components under detection risk. How you fail to detect, that is sampling risk and non-sampling risk. So when I started with the video, I told if there are thousands of transactions, I'm not going to audit the complete thousands of transactions. I'm just going to audit 40. Okay, 40 transactions. Now this is called sampling risk. I'm not going to choose the complete thousand, or I'm not going to do to an extensive level. Not going to be a extensive one. It's just going to be 40 samples. Now, what if there are misstatements? With this 40, I'm just going to conclude the financial statements are not materially misstated. It is free from material misstatements. But I might be wrong because there are 960 other transactions which I have not touched at all. There could be higher material misstatements even, which could even change my audit opinion with this 960. So this creates the sampling risk. Non-sampling risk is where I'm going to assign inexperienced staff, okay, and I do not have proper knowledge or skills which the staff I have assigned, they don't have the appropriate skills and knowledge in order to perform the audit of this particular company. Okay, then that could be non-sampling risk. So totally these two risks could increase my detection risk. Okay, that is I fail to find out the risk of material misstatements. Now, coming back, I told inherent risk and control risk. What if it is very much higher in the client firm that I'm going to audit? I should make sure that my detection risk is low. Only then the audit risk could come low to acceptably low level. So I should always make sure the audit risk is nothing but risk of providing an inappropriate audit opinion. I cannot provide an inappropriate audit opinion. I have to bring it down to an acceptably low level. So, in order to bring down the audit risk, I cannot have responsibility for, I don't have the responsibility of inherent risk and control risk. I cannot touch upon that. They are already higher in the organization which I'm going to audit. So, what is in my hands? I can reduce the detection risk. I can reduce the sampling risk. I can reduce the non-sampling risk. Okay, so that this detection risk comes down. For example, I told with the audit approach, if the internal controls are higher, I don't have to perform more of substantive testing. But now, with this example, I'm telling inherent risk and control risk are higher, which means to avoid the sampling risk, I can audit a higher number of samples. So the sampling risk could be reduced. Then to avoid the non-sampling risk, I can assign experienced staff. Okay, I can make sure even if I have some inexperienced staff, whether they are being monitored by an experienced staff. Okay, so these are the ways in which I can reduce the non-sampling risk. So totally, I'm going to reduce the detection risk, which is in my hands. That is auditor's responsibility. So now as I've reduced this, automatically my audit risk comes down. That is, I have to make sure it is acceptably to a lower level. Okay. So these are the things that you have to remember regarding the audit risk. Now, what are the stages in which I'm going to consider the audit risk? So it will be considered first of all during the understanding the entity particular stage and then during the planning stage. So understanding stage, you will be following as per ISA 315, identifying and assessing the risk of material misstatements through understanding the entity and its environment, right? So that is ISA 315. So during the understanding of the entity stage, this audit risk will be considered, and during the planning stage, okay? Uh, Basically, this audit risk is considered throughout the audit. So the important things that you have to remember is ISA 315 and ISA 330. ISA 330 is where you are going to work towards bringing the audit risk to an acceptably low level. So what is ISA 330? So in order to bring it to a lower level, why am I telling ISA 330? Because that is the auditor's response to the assessed risk, right? Now, based on the assessed risk, how is the audit, how the auditor is going to respond? You have to bring the audit risk to an acceptably low level. So these are the stages in which we are going to consider the audit risk. Now, whether we will be able to eliminate the audit risk completely. So there is an audit risk, whether we can bring it down to zero, which means this is nothing but whether you can give an absolute assurance. This is also interrelated. So if my audit risk is zero, there is no risk at all, then I'll be able to provide an absolute assurance as well, right? It's not necessary that I can only provide a reasonable assurance. Even I can provide an absolute assurance. There is no audit risk at all. Controls are completely in place. Okay. This is not possible. You cannot eliminate the audit risk to zero because you cannot guarantee or you cannot provide an absolute assurance. So, audit risk can be just brought down to an acceptably low level, but it cannot be completely eliminated. Okay. Then, once you have found out the risky areas, we are going to the next stage. Okay. Now we have found out the risky areas. First, what did we do in the audit strategy? We understood what is the entity about, what is the nature of the entity, and all the things, understanding the entity. Second, once we have understood regarding the entity, we, based on the understanding, we found out the risky areas in the financial statements. Now, once this is done, now we have to look at the materiality level. That is, we have to decide the materiality level. So this is the last stage before your audit plan. So you're going to formulate a complete audit approach, audit strategy, right? So you have to define the materiality level. Now, once you have defined the materiality level, so now you have defined the materiality level, then you will be implementing the audit strategy. That is, you will be formulating an audit plan using the audit strategy. Okay. So hope till this it was clear. Audit plan I'll be covering in the next video. Before that, materiality level, I have provided a complete detailed video on materiality level and also the performance materiality. Materiality and performance materiality is one particular important topic that you have to definitely remember before appearing for the long answer type questions also. Okay, so you will be expected to calculate the materiality levels. For that, you need to know how to choose the materiality level. What is the basis in which you can choose the materiality level? You need to know the difference between materiality and performance materiality. So this one I have already provided a complete detailed video with examples. I will provide that video's link in this description. Okay, do watch that video before watching my next video on the crash course. Okay. Other than this, if you would like to, okay. Other than this, if you want me to discuss any other particular topic which is important, or you have any doubts, you can. Even in this video, if you have any doubts or other things that you want me to discuss, you can post it in the comment section. I'll definitely look forward to posting a video on that as well. Thank you.